In the year 2000, a financial analyst in Boston sat down and did some arithmetic. It took him about 5 minutes to become certain that the most respected money manager in America was running a fraud. So he did the responsible thing. He wrote it up and sent it to the United States government, to the Securities and Exchange Commission, the agency whose entire job is to catch exactly this. He named the man. He showed the math. And then he did it again. And again. For 9 years. Each time, the government read his warnings. It opened investigations. It sent examiners into the man's own offices. And each time, they walked back out and let him keep going. The man they let keep going was named Bernie Madoff. The statements he mailed his client said that, together, they held around $64.8 billion. Almost none of it was real. It was the largest Ponzi scheme in human history, and it had been reported to the authorities, in writing, with the math attached, nearly a decade before it finally fell apart. So here's the question this story turns on. How does a fraud this enormous get handed to its own watchdog, named, explained, documented, and survive anyway? Follow the money. To understand how the SEC could look straight at Bernie Madoff and see nothing wrong, you have to understand who he was. Because he was not a stranger sliding into town with a suitcase and a pitch. In many ways, he was Wall Street. Madoff founded his firm in 1960 with a few $1,000s he'd saved working as a lifeguard and installing sprinkler systems. And over the next 30 years, he built it into something genuinely important. His company, Bernie Madoff Investment Securities, became one of the largest market makers on Wall Street, a firm that helped buy and sell enormous volumes of stock, matching buyers to sellers. Real business. Real trades. He was an early champion of the electronic trading that would eventually become the NASDAQ stock market. And at one point, Bernie Madoff wasn't merely a member of that world, he served as the non-executive chairman of NASDAQ itself. The man later accused of the biggest investment fraud in history had, for a time, sat near the very top of one of the largest stock markets on earth. He helped write the rules. So when Madoff offered to manage your money, he wasn't a nobody with a brochure. He was a legend. And the legend ran 2 businesses out of the same Manhattan building. Up on the 18th and 19th floors sat the real one, the legitimate trading firm everyone could see. But down on the 17th floor, behind a locked door, was a second operation, a private investment management business. And it was this one that would quietly swallow the savings of tens of thousands of people. What made that business so seductive wasn't a promise of getting rich quick. Just the opposite. Madoff didn't dangle spectacular returns. He offered something that, to a certain kind of investor, is even more attractive: calm. Year after year, his fund returned something in the neighborhood of 10 to 12%, never a moonshot, never dramatic, but steady. Steady when the market soared. And, impossibly, steady when the market crashed. His client statements climbed in a smooth, gentle line while everyone else's lurched and bled. And he made it exclusive. You couldn't simply walk up and hand Bernie Madoff your money. You had to be invited. He would even play hard to get, hint that the fund was full, that he might, as a personal favor, let you in. It made people desperate to give him their savings. Country clubs, charities, universities, whole communities passed his name around like a secret blessing. Getting into Madoff's fund felt less like an investment and more like being let into the room where the smart money already sat. There was only one problem with that smooth, gentle, beautiful line on the statements. It was impossible. Here is what Madoff told his investors he was doing. He called it a split-strike conversion strategy, a real technique that involves holding a basket of big, stable stocks and using options to cushion against losses. It's a genuine approach. What it is not is a machine for producing steady, positive returns in every kind of market, year after year, for decades. Real markets don't move in smooth lines. Any honest version of Madoff's strategy would have had good years and bad years, ups and downs. He's had almost no downs at all. The reason his line was so smooth is devastatingly simple. There was no strategy. For the investment business on the 17th floor, there were, essentially, no trades at all. Investigators later found that the arm supposedly managing billions of dollars wasn't buying those stocks or those options in any real way. The steady returns weren't earned. They were typed. Madoff and a tiny handful of employees simply generated account statements showing whatever gains he decided on, printed them, and put them in the mail. So where did the money come from when a client wanted to cash out? From the next client. This is the entire mechanism of a Ponzi scheme, named for Charles Ponzi a century ago, and Madoff was running the largest one that has ever existed. When an old investor asked for their money back, Madoff paid them, not with profits, because there were none, but with the fresh cash that new investors were pouring in. As long as more money came in than went out, the scheme survived, and everyone's statement showed a happy, growing number. Numbers that were, quite literally, fiction. And no one can say for certain exactly when it all began. The fake trades run back at least to the early 1990s, and possibly much further, into a past Madoff took most of with him. Now I want to separate three figures very carefully, because this is where the story usually gets blurred, and the difference between them is the whole shape of the crime. The first number is the one printed on the statements. When it finally collapsed, in December of 2008, the account statements Madoff had mailed out claimed his clients held, altogether, about $64.8 billion. That was the fantasy, the sum of all those typed in, imaginary gains. The second number is the real one. The actual cash that victims had put in and never got back, the true principal that vanished, was around $17.5 billion. Still one of the largest thefts in history. But notice the gap. The $64 billion on the statements, minus the $17 billion of real money, is a mountain of pure invention, decades of fake profit that never existed anywhere but on paper. And the third number shows the sheer scale of what churned through the machine over its lifetime. When Madoff was later ordered to forfeit his ill-gotten gains, the figure the court arrived at was around $170 billion, the total amount that had washed through his main account over the years, as money flowed in, got recycled to pay other investors, and went round and round again. So hold the three side by side. $64 billion in fake statements. $17.5 billion in real losses. $170 billion churned through the machine. Three different numbers, three different meanings, and keeping them straight is the only honest way to grasp the size of what he did. To keep the machine fed, Madoff had help, not necessarily people who knew it was a fraud, but people with every incentive not to look too closely. So-called feeder funds gathered up money from thousands of investors and funneled it straight to Madoff, collecting handsome fees for the service. Some of them handed him effectively everything their clients had, on trust, doing almost no independent checking of their own. They were selling access to the magic line. They didn't ask how the magician did it. And the red flags were everywhere, for anyone who cared to look. A firm supposedly managing tens of billions of dollars was audited by a tiny, unknown accounting shop with a handful of staff, nowhere near large enough to check a giant. Madoff kept custody of the assets himself, rather than letting an independent bank hold them, which meant no outsider ever verified the money was actually there. And he reported through paper statements sent by mail, sidestepping the real-time electronic systems that would have instantly exposed the missing trades. Any one of these should have stopped a serious professional cold. Which brings us to the man who saw all of them at once. His name was Harry Markopolos, and he was a numbers guy at a rival firm in Boston. In the late 1990s, his own bosses asked him to reverse engineer Madoff's strategy so they could offer something similar. He couldn't. Not because he wasn't smart enough, because the numbers didn't add up. The returns Madoff was reporting were, given the strategy he claimed and the size of the markets he claimed to be trading in, mathematically impossible. Markopoulos later said it took him about 5 minutes to know it was a fraud and a few hours to prove it. So he told the SEC. In 2000 and again in 2001, he brought his analysis to the agency. Then, in November of 2005, he submitted a detailed memo with a title that left nothing to interpretation: "The world's largest hedge fund is a fraud." In it, he laid out dozens of red flags and stated plainly that Madoff was, in all likelihood, running a Ponzi scheme. He didn't hint. He named the man and the crime. And the SEC, the most powerful financial regulator in the world, did investigate. That's the part that is almost too much to believe. This was not a case of nobody looking. Examiners opened inquiries. They sent lists of questions. They even went inside Madoff's offices. But they never did the one simple thing that would have blown the scheme wide open in an afternoon: independently check with the outside clearinghouse that records America's stock trades whether Madoff's supposed trades had ever actually happened. Had they made that single call, they would have found nothing, because there was nothing. Instead, dazzled by his reputation and tangled in their own confusion, they cleared him. More than once. An investigation the SEC later ran on itself reached a brutal conclusion: the agency had received credible, specific warnings about Madoff for years, and repeatedly failed to act on them. The watchdog had been handed the fraud, wrapped and labeled, and set it back down. So what finally stopped Bernie Madoff? Not the regulator. Math. In 2008, the global financial crisis hit, and frightened investors all over the world began pulling their money out of everything, including Madoff's fund. By that autumn, clients were asking for around $7 billion back, and Madoff, for all his imaginary billions, did not have it. A Ponzi scheme dies the instant more money tries to leave than is coming in, and the crisis had triggered exactly that. Cornered, with the cash draining away, Madoff confessed, first to his sons, who worked on the legitimate side of the firm and later said they had no idea. He told them the whole thing was, in his words, one big lie. That night, his sons reported him to the authorities. The next morning, December 11, 2008, the FBI arrested him in his apartment. In March of 2009, Bernard Madoff pleaded guilty to 11 federal felonies. He offered no defense and cut no deal. That June, a judge sentenced him to 150 years in prison, a symbolic number, longer than any human life, meant to stand in for the thousands of lives he had wrecked. Charities shut their doors. Retirees who believed they were comfortable discovered their accounts held nothing. One of his sons died by suicide 2 years later, on the anniversary of the arrest. Madoff himself died in prison in 2021. And a court-appointed trustee began the slow, grinding work of clawing money back from those who had taken more out than they'd put in, eventually recovering a large share of that real, $17 billion principal, though it would take well over a decade. So who's to blame? Bernie Madoff, obviously. He built the lie and ran it for decades, and he died a convicted felon for it. That part is easy. But if you stop at the villain, you miss the same uncomfortable lesson buried in every one of these stories. Because Madoff didn't succeed by hiding from the system. He succeeded by being the system. He wasn't an outsider slipping past the guards, he was a former chairman of NASDAQ, a pillar of the same Wall Street that was supposed to police him. And his fraud wasn't invisible. A whistleblower had handed it to the regulators, in writing, with the math worked out years in advance. Every safeguard we build to stop a Bernie Madoff, the regulator, the auditors, the due diligence of sophisticated funds, was present and accounted for. And every single one of them failed. Not because the fraud was clever enough to hide, but because the man was trusted enough that no one wanted to look. That's the pattern worth carrying out of this. We like to imagine fraud as something that lurks in the dark, something we'd surely notice. But the biggest frauds don't lurk in the dark. They stand in full light, wearing the credentials, holding the titles, backed by the reputations, and that borrowed trust is the exact thing that makes people, and even regulators, stopped checking. And there was one tell the entire time. The line was too smooth. In a world that genuinely goes up and down, Bernie Madoff offered a return that only ever went up, calm, steady, never a bad year. That impossible smoothness wasn't proof he was a genius. It was proof he was lying. Because when someone promises you the one thing markets can never give, certainty, that isn't the absence of risk. It's the disguise of it. The most trusted man on Wall Street, running the emptiest fund in history, waved through for years by the very people paid to catch him. If that kind of borrowed trust fascinates you, we told the story of another supposed genius, a crypto wunderkind whose multi-billion-dollar empire turned out to be just as hollow, and collapsed just as fast. That one's one click away. Follow the money.